Hi, and thank you for joining us on this new live. Yeah, new live. We just call it a new live. I was going to go with broadcast, but that's awful. Anyway, today we're going to be talking about how to reduce your mortgage payments when rates are rising. I'm sure if you've got a mortgage, you know very well by now that rates have increased, and with that, your monthly payment either has already gone up or will be going up when your current fixed deal comes to an end. So obviously, that's bringing about worry and everything else that goes along with that. The good news is there are some things that you're able to do, and ultimately that'll put some money back in your own pocket for a change rather than the lenders. So we're going to run through these different ways of doing this right now to make sure that you know what your options are. So let's get into it. Okay, so how to reduce your mortgage payments when rates are rising. Some of these things may be obvious to some, but maybe not to everybody. So what's happening and why is it happening? Well, and right now, the why why is it happening is interesting. So what is actually happening is rates are increasing, and the Bank of England are continually increasing their base rate. But what's happening very specifically right now, and we're talking this, we're in June 2023, and by the time you watch this, who knows what have happened? But in June 2023, we are basically waiting for the Bank of England to continue to increase their rates. Now, what mortgage lenders are doing right now is they're trying to price that in. And what's happening is lenders are continually just withdrawing products with very little or no notice whatsoever. And that's causing some panic within the industry. Ultimately, regardless of that, if you took out a fixed rate over 12 months ago, you're going to be on a very decent rate at the minute, anywhere from 1 to maybe even 3%. When you come off that, you're going to be going onto a rate that is higher than that. And the average, apparently, at the moment that's being added onto people's mortgage is about 300 odd pound. Now, that obviously very much depends on the size of your mortgage. So take that with a little bit of a pinch of salt. But that gives you an idea that there is an increase that's happening. And you've kind of got to budget that in. And that's not easy when you're in the middle of a cost of living crisis. So everything's gone up. Food, fuel, well, that's come down a little bit recently, but you get the idea. So the first thing you need to look at is your mortgage term. Now, you may be with a lender who is a little bit sort of more focused on your retirement age. And if that's the case, they're going to say, right, your sort of statutory retirement age is 67, 68, or whatever it is, and they won't let you lend anything beyond that. There are lenders out there that will allow you to go up to the age of 75. So as long as you intend to work up until the age of 75 and you've got a job that could potentially still be done at the age of 75. So sorry to the roofers out there, but generally I can't convince a lender that a roofer is going to keep going until the age of 75. But that's one way of lowering your monthly payment. And just remember, the focus of this particular live is just to reduce your monthly payments. Naturally, if you increase your mortgage term, you get your mortgage for longer. It means you're going to be paying more interest in the long term. So only do this if you really need to be saving on a monthly basis. But ultimately, if you can't afford the increase that's coming, you need to look at what options are available. Now, the other way to look at this is obviously analyze your monthly outgoings. And there's a few ways that you can do this. And I'm not talking about your Netflix subscriptions and everything else, but you'll be really surprised in just how not easy, but how easy it is to miss what can be quite a simple saving to make. And you need to really look at, can you consolidate debt? And before you switch off at this point, let me explain what I mean. So if you take this, for example, let's just say you've got 3 things outstanding. So one's a car loan, one's a loan for some furniture that you took out, and another is a home improvement loan. The important part and the thing you have to notice on these is your monthly payments here are actually quite high. But if you've had these debts for a while, then actually the balance that's outstanding on these debts is reasonably low, or will be lower than maybe what you think. So in this particular instance, if you decided to consolidate this, it would actually only work out at £6,000. And that £6,000 would save you about £659 per month. using that example. So I'm not saying you're all going to be in this position. There's going to be some of you that may have only just taken out a loan, or actually what you've got is higher than or the balances are a lot higher, so it doesn't really make any sense. But I'm coming across some people recently who, when we look at their credit and we think, right, how can we save on a monthly basis? Then by picking out the sort of lower loan amounts, so those that have only got, say, £2,500 outstanding on it, and because you had them for so long, the monthly payment doesn't change, but the balance drops. Now, I'm not saying you should consolidate debt unless you absolutely have to, because ultimately that £6,000 that's probably going to be paid off in like 12 months time or whatever it is now going to be paid off in 15, 20 years time. So again, you're going to be paying more interest in the long term. So don't do this unless you absolutely have to. But if the goal here is, how can I keep paying this on a monthly basis? How can I afford to do this? Then ultimately that's an option. Have a look at your credit file, have a look what you've got outstanding. It's really easy. Jump onto something called Check My File. That'll allow you to download all of your credit files in one go and just go through them and just work out what's the balance, how much am I paying on a monthly basis, and what would it cost me. So in this example, £6,000 in order to save myself on a monthly basis, because ultimately people's incomes, although have gone up a little bit, they haven't gone up as much as what all the increases have. So we've got to see if we can cut back somewhere. So that's an option. Now, the other option that isn't really talked about and is actually really difficult is to split your mortgage. Now, you can put some on repayment and some on interest only. Now, this is not a particularly popular option, and the reason I say that is very simply it's really difficult to get it. Lenders don't like doing this stuff, and there's some really weird criteria that you need to hit in order to do it. But for the right people, and this is going to be either your higher earners, so if you're earning, say, £50,000 a year, for example, or if you've got some decent equity in your property, so anywhere between £200,000 and £250,000 worth of equity in the property. And just to explain equity, obviously that's the amount that you really own of your property. So if your property is worth £500,000 and you have a mortgage of £250,000, your equity is also £250,000, so it's the other half of it. So if you've got a decent amount of equity, then that's something that you can consider. Now, this is a bit of a controversial one, and the reason I put it in here is some tracker rates at the moment are lower than the fixed rates. You've got to consider that fixed rates, it is the bank taking a gamble for a period of time. So if you are taking a 5-year fixed rate, it's kind of gambling on what the rates are going to be over the next 5 years. And at the moment, because things are really uncertain, then it's, they're kind of hedging their bets on the rates are slightly higher. That said, if it is a tracker rate, if the base rate then decides to increase even more, then actually a fixed rate where it may have been better. It's quite difficult on you unless I know your circumstances, but tracker rates work brilliantly in the right circumstances. So if you've got a low mortgage, for example, I've got a couple of clients who've got quite low mortgages but very good income. Actually, if their mortgage went up quite significantly on a tracker rate, it's something that they could cope with. But so for now, they'd like to stay on a tracker rate to make sure that or to try and get the best interest that they can possibly get. Just a quick note, a tracker rate is not the standard variable rate. The standard variable rate is what you go on to at the end of your product term. That is generally not a good idea. If you can get off that, that is exactly what you should be doing. More importantly, and I'll put this on the screen, if you are struggling, talk to your lender. There's nothing here. If nothing here helps and you're still sort of struggling on a monthly basis in order to meet everything you need to pay every month, then have a chat with your mortgage lender. There are things that they can do. The regulator, the Financial Conduct Authority, have now given them rules and things that they need to follow. A lot of these things will affect your credit file. There's absolutely no doubt about it, but it is better than missing mortgage payments because, in all honesty, there's nothing worse and obviously can end up in repossession. So if you are struggling, have a chat with your lender to see what they can offer, and seek advice. Please, before you do any of these things, have a chat with a mortgage broker, because they can go through your circumstances and give you the best idea or the best proposals for you based on your own details. Obviously, not everyone's gonna listen to that, and I understand why. But just that's the best advice I can give you. Just don't do anything silly that could have been avoided if you just asked the right question to the right person. So probably not your mate in the pub, unless your mate in the pub is also a mortgage advisor. And the way that lenders are going at the moment, most of us are probably in the pub. So yeah, why not? Anyway, last one on fees. Those of you who've seen these videos before will understand this. So this is your good, fast, good, cheap, and fast. You can pick two, but you can't have three. So if you want something that's good and cheap, it's probably not very fast. If you want something that's cheap and fast, it's probably not very good. You get the idea of it. And this comes down, what I'm specifically talking about here is broker fees. Some brokers do charge a fee, others don't. And just bear in mind that little scenario when you're looking at it. And for now, that's it. Nothing else to go through. If you've got any questions, obviously drop it in the comments or let me know, and I'll see you soon.